Hey everyone, it's Brandon from the Young Investors Podcast. Myself and Hamish are excited to bring you your weekly rundown of the latest business and investing news from around the world. A quick reminder before we get started that any advice provided by myself is general and does not consider your financial situation, needs, or objectives, so consider whether it's right for you. Brandon Kolk is authorised to provide general financial product advice in Australia and is authorised representative 1305795 of Guideway Financial Services Proprietary Limited, AFSL 420367. Please see the description box for my financial services guide. Past performance is not a reliable indicator of future investment returns, but with that said, let's get into another episode of the Young Investors Podcast. All right, everyone, welcome back to yet another episode of the Young Investors Podcast. Hamish, what's up, bro?
What's up? Not much. We had the what do we have? The AFL Grand Final weekend, long weekend over the last weekend, and I took a nice. Yes. Everybody got a nice Friday public holiday in Victoria, and I took a work holiday. Well, I didn't take a work holiday. Yep. I did work on Friday, and then I also did work on Saturday. So I didn't even watch the grand final. But was it a good game? I saw that it was pretty one-sided at the end.
Yeah, it was one-sided. It was a close contest in the first quarter, and then after that, it was all Brisbane.
Yeah.
But yeah, the second quarter by Brisbane was phenomenal. Amazing football. Not that anyone outside of the borders of Australia cares, but but yeah, it is interesting on that point about the public holidays. Once you work for yourself, public holidays just don't mean anything anymore. That's kind of the one sad thing about working for yourself. Is that there are no public holidays.
Yeah, they're almost worse than not meaning anything, because I feel like I kind of should be working on those days. Like I don't even feel often that I should just take a day off. Whereas, I guess for most people, it's kind of a nice break and you still get paid. But is what it is.
It's a small blessing in disguise because you tend not to get many emails on the public holiday days.
True, that is true.
So that's one thing that's quite nice. Anyway, Hamish, yes, what are we talking about today? I'm talking about the recent stimulus in China, which is quite interesting because that is absolutely pumping the Chinese stocks at the moment. Also, troubled Boeing is going to try and raise $10 billion by selling some fresh new shares. So I'll talk about the implications of that.
Yeah.
And what are you chatting about?
Yeah, and speaking of selling shares, OpenAI has just finished a very, very significant round of funding. So we'll talk about their fresh valuation and who's been investing as well. And Costco is expanding its commodity product line. We know that they've been selling gold and silver, and they've moved on into new commodities. So I'll talk a little bit about that as well.
Oh, all right, let's do it.
So with that said, today's episode is brought to you by Seeking Alpha, your one-stop shop for stock analysis, market data, and news. Access expert analysis and news for thousands of stocks. View buy, hold, and sell ratings from members, Wall Street analysts, and Seeking Alpha's own algorithm. Screen for stocks using a variety of fundamental and technical analysis metrics. Access 10 years of financial data and company filings, and manage your portfolio by tracking your investments with price alerts so you never miss a buying opportunity again. Click the link in the episode description or head directly to seekingalpha.me/young investors to try Seeking Alpha free for 7 days. Do you want to kick us off by let's talk about the Chinese stock market and what's been going on, because I haven't seen any of this. I know the Chinese government did they did some stimulative action maybe a couple of weeks ago or a week ago, but I'm completely out of touch in terms of this story, so take us through it.
Well, I want to start, you're correct, the Chinese government did do a lot of stimulus, or they announced a lot of stimulus measures like a week ago, I think, and I wanted to start by talking through what's happened then in terms of some of these Chinese stocks that a lot of investors follow, talking like Alibaba, JD.com, Tencent, Baidu, these kind of companies. So just in the last couple of weeks, Hamish, I'm not even kidding, Alibaba is up 36%, JD is up 66%, Baidu 33%, Tencent 25%.
Wow.
So bang, 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 bang. Yep, in just the last couple of weeks, investor sentiment, I I was going to say is completely turned around. I wouldn't say that's exactly correct, but it's gotten a lot more positive. And this news of stimulus has definitely started to get priced into these Chinese companies. I've got a little note here. The Hang Seng China Enterprises Index climbed as much as 8.5% yesterday before closing up 7.1%, which was a 13th straight day of gains.
Wow.
So 13 days in a row where that went up. And yes, the reason why, as we were talking about before, is because the Chinese government, the CCP, have decided to do some stimulus measures. So there were a lot of different schemes and measures that they decided to implement. So I'm not going to go through all of them, but I will read you kind of what the article is kind of summarized here. It said, sentiment towards equities in the world's second biggest economy has seen a dramatic turnaround since the start of last week as authorities unveiled a range of stimulus measures that included interest rate cuts, freeing up of cash for banks, so they actually lowered reserve requirements, and also liquidity support for stocks. 4 major cities also eased home buying curbs, including lowering the deposit requirements for first and second homes, and the central bank moved to lower mortgage rates. So it says the Politburo pledged action to make the real estate market, quote, this is their quote, stop declining. That is their goal.
Please stop.
To make the real estate
Make it stop.
Exactly right. Its strongest vow yet to stabilize a sector that makes up the bulk of Chinese household wealth. So many different smaller initiatives and schemes and interest rate cuts, but broadly help the property sector and pump the stock market.
Yeah, and I think we've probably mentioned it a few times, but I believe the property sector is about 30% of GDP, I believe, in China, and I think maybe 70% of household wealth. So
it's crazy, isn't it?
It's pretty significant, and it's been rough in China, really ever since Xi Jinping started increasing regulations around some of the big property developers, and then we saw obviously some of the big fallouts such as Evergrande having to sell a bunch of assets and go into bankruptcy. So it's been a bit of a waiting game for I guess you could say for the Chinese stock market, for example, hoping that there would be some stimulative action from the government.
Yep, you're exactly right, Hamish. You are exactly right. And the stimulus has come and the stock market has responded. And interestingly, beyond the real estate stuff, there was actually some direct stimulus for Chinese stocks as well, which I found quite interesting. So they said Governor Pan Gongsheng recently announced a swap facility allowing securities firms, funds, and insurance companies to tap PBOC, People's Bank of China, money to purchase equities. This will be worth an initial 500 billion yuan, which is 71 billion USD, with a possible ceiling of 1.5 trillion yuan, so 3 times that. A re-lending facility as well for listed companies and major shareholders to buy back shares and raise holdings. This will be worth an initial 300 billion yuan with a possible ceiling of 900 billion yuan. And then they're also throwing around the idea of some sort of stabilization fund, but I'm not quite sure what that might entail or what that would mean.
Right.
So yeah, direct stimulus as well for Chinese stocks. And what else have I got to talk about here? Yeah, pretty much just, I guess you've already kind of covered it a little bit, but the backstory behind all of this is, and why the CCP has drawn quite a bit of criticism is because out of all the kind of economies, the major economies, coming out of their COVID lockdowns, they were the predominant ones that chose not to do drastic stimulus. And of course, as you mentioned, that combined with the faltering real estate sector, kind of self-inflicted in a way, but you can understand why they did it with the 3 red lines policy, so that real estate developers were kind of reined in with the amount of debt they were taking on. But yeah, that all hit Chinese real estate hard. It hit the Chinese consumer hard. As you were saying, 70% of household wealth is in property with the Chinese. And ultimately it flows down into citizens that don't spend money, and you've got a contraction in the economy. But this really does seem, in my perspective anyway, to be quite a drastic change of sentiment or direction from the Chinese government. And I think it was that sudden kind of pivot in direction or sentiment which made investors so suddenly bullish, because it feels like we're going the other way now, which will be interesting.
Yeah.
I also wanted to just note as well that while this is obviously positive news for Chinese stocks, as we've said many times before, there are still risks, as I'm sure that you would also say, Hamish, if you were talking about Chinese stocks. Of course, opinion is still mixed. There's obviously a trade war between the US and China. There's obviously geopolitical tensions. The Chinese are trying to diversify away from the US dollar. There's delisting risks still floating around, although up to you how much you think they are legitimate. There's risks around this VIE structure, because of course we can't directly buy into Chinese companies. So the way around that is that they create offshore entities that are entitled to the profits of mainland Chinese companies like Alibaba, and then we as investors buy the shares in the offshore companies. But that could be cracked down on. So I think you'd also agree with me that there still are risks, even though this is quite a positive and you see all the stocks go up. There's still quite a few risks out there.
Yeah. And I mean, in particular with the US election coming up, there's obviously trade has been a very significant topic of point in this election, with Trump saying that he wants to put enormous import tariffs on Chinese goods, and so I think whether or not you just think that's just rhetoric, or how it will actually play out depending on who gets elected in November. But there is a fair bit of I think political uncertainty around import tariffs and other kind of restrictions that the US government might put on Chinese goods, and how that affects those businesses.
The only other thing I wanted to add, Hamish, is the only other big bit of criticism, I guess, around this stimulus from the Chinese government is that they haven't really said exactly what they're trying to do with it. So they haven't really given any sort of goals. You know how the Fed comes out and says we want to get long-term inflation back down to 2%. The Chinese, they haven't really come out and said we want to try and achieve this. We are doing this stimulus to achieve this, that, and the other. They've previously noted they're targeting around 5% GDP growth in 2024. So I guess that's a loose goal that they have.
Yep.
But in terms of the recent stimulus, really the only goal that they've noted is to stop the decline, as we said before. So that's drawing some criticism, because it's making investors unsure as to how long the stimulus is going to hang around for, whether it's going to revert back. Is this a true change of sentiment? Is this a short-term thing, a long-term thing? So that's still a little bit up in the air. But, stop the decline. It's well needed as well. I was just taking a look at that Hang Seng Enterprises Index, and at its worst, it kind of peaked in 2021. At its worst, it was down almost 60% by the beginning of this year from its peak, which is obviously an enormous decline. It's been a very, very long time since, say, the S&P 500, for example, has seen a 60% retraction. I'm not even sure if it retracted 60% during the global financial crisis. It would have been around there, but you have to go a long way back to get to 60. Yeah, I think 60% was a bit bigger than, I think the GFC was around 50%, if I'm not mistaken.
I think so. Yeah. So I think you're going a log many decades back to find a 60% decline. Since then, so year to date, that index is up 36%, and most of it has come in the last couple of weeks. Around all of this, 30% in the last couple of weeks. So. It's a well-needed reversal, but it's certainly, even still, from its peak, down 36%, even after the significant rally recently. So, it's going to be that's crazy. It's going to be a long way back, I think.
But that's what I got to talk about for the Chinese stimulus. We shall see what happens next. Do you want to talk to us about this OpenAI funding round?
Yes. So OpenAI has been, everyone's kind of, I'm sure, very aware of OpenAI and their kind of flagship AI product, ChatGPT. And it has finally finished its long-awaited funding round, raising capital at a valuation of $157 billion.
That's huge.
Yeah, when it comes to these kind of private companies, obviously there isn't a stock market, so there's no live valuation. We don't get a day-by-day valuation, but every time they raise capital, they do it at a certain price, of course, selling a percentage of equity for a certain dollar amount. And so we get these kind of milestones or these like intermittent valuations. And the latest is $157 billion. And this is a massive round. They raised $6.6 billion from an extensive roster of investment firms and tech companies. While OpenAI didn't name the investors in Wednesday's press release, a person with knowledge of the matter said the round was led by the following companies. So there was Thrive Capital, which is a venture capital firm, planned to invest $1 billion. It also included participation from Microsoft, who had already invested, I believe it was $10 billion, or maybe there was an additional investment on top of that as well. I'm not sure. Chipmaker.
I think it started smaller and then it came up to 10 billion.
Right. Okay. So it
Or
was.
there was another 10 billion. Yeah.
Yeah. Okay. It also included chipmaker Nvidia, SoftBank, who's always in the mix there when it comes to tech startups, and others. So some very big names getting involved in this $6.6 billion capital raise. The new funding will allow us to double down on our leadership in frontier AI research, increase compute capacity, and continue building tools that help people solve hard problems, the company said in a press conference on Wednesday. We also have a little bit of information about how the company is performing financially, which I think we were talking about OpenAI maybe last week or the week before. And one of the kind of things we don't really know that much about is the actual financials of the company, which I think we were talking about how if they ended up going public, then we would be able to see on a quarter by quarter, year by year basis, how much revenue and profits they're producing. But for now, we kind of just have to get bits and bobs from people leaking from inside the company, and then obviously the occasional milestone that OpenAI decides to share. But we do have a little bit of insight into the company. OpenAI generated $300 million in revenue last month. So they're doing $300 million a month in revenue, which was up 1,700% since the beginning of last year, according to an insider at the company.
Wow.
They're forecasting, and this is all kind of leaks from an unnamed person inside the company who didn't want to be named because this is all confidential. But they're forecasting $11.6 billion in revenue next year, which would be up from their forecast of $3.7 billion in 2024 this year. So they are expecting to make almost $4 billion this year, and they think it'll be almost $12 billion next year.
It's quite a lot. It's more than I expected, to be honest.
Yeah.
I don't know what I would have expected, but I was quite shocked when you said 300 million in revenue last month. That's quite surprising. But I guess there's a lot of businesses. I just think like it's a consumer-facing product, but I guess a lot of businesses as well use this sort of stuff, so makes sense.
Yeah, exactly. And where exactly is that coming from? Well, OpenAI now has 250 million weekly active users on ChatGPT. The chief financial officer, Sarah Fryer, told CNBC last week. So they have 250 million weekly active users. Obviously, most of those people are not paying for ChatGPT, but that gives you an idea of I guess maybe a potential market for upselling to their ChatGPT Plus. In terms of the ChatGPT Plus subscription, which I believe is like $30 a month or something. I'm not sure if it differs from place to place. That's how much it is in Australia at least. But they have 11 million subscribers. Yeah, that's obviously where the bulk of their 300 million a month revenue is coming from. And they also have 1 million paying business users on ChatGPT as well. And so
crazy. Yeah, that makes sense. That's a lot. That's a lot of people. It's surprising how this is such a young company and it's just taken off so quickly. But it's so useful. Like I kind of didn't use it for a while. These days I use it all the time, literally all the time. I'm using it probably on the daily. to help with my workflow in one way or another.
Yep.
It's so handy. So I'm not surprised actually now.
Yeah.
Now that I think about it, it's insane.
Yeah, I'm using it quite a lot, and it's kind of funny because I think the biggest limiting factor is I just don't think that it can do certain things until one day I'm just like, you know what? I'll just try it, and it surprises me and it works. You know, you doing things like putting in raw data for the S&P 500, like 25,000 lines of daily data, and just saying, hey, can you just pull out every September and average the returns, which I did a video looking at September returns because it's been historically weak. And I didn't know how to do the formulas, and I was like, maybe ChatGPT can do this. And in like 5 seconds, it does it. And obviously, I went through and I checked, that it was correct. I didn't just trust that it was correct, but it was correct, and it did it in about 5 seconds. And if I did that manually, even with formulas, it would have taken me probably an hour, half an hour, or something like that. And so. It can do some things. It can do a lot. So I think the market for it is probably very, very significant. Not just for businesses, but really for everybody. There's probably some ways that it can be used.
Agreed.
So that's kind of revenue. So $4 billion in revenue from their enormous customer base, but that's not profit, right? And that's why they're raising capital, is because it is very, very expensive to generate that revenue. OpenAI has been ramping up its purchases of NVIDIA's graphics processing units, their GPUs, to train and run its large language models. Again, from this kind of insider who was like leaking stuff, the company is expected to lose $5 billion this year. So even though they're going to make almost $4 billion in revenue, they're going to be spending about almost $10 billion. So that is why they need to raise capital. They are growing, they're producing revenue, but it is very, very expensive to run these models and to train these models as well.
NVIDIA's laughing. They love it.
Yeah, they're the one in the gold rush selling the shovels.
Yep, you're not wrong there, Hamish.
Yeah, exactly. So they raised capital at a valuation of $157 billion. This is up from a valuation of $80 billion earlier this year. So they raised capital earlier this year at $80 billion. So they just doubled it from that valuation, and $29 billion in 2023. So if they were a stock, it would have a chart that looks very much like NVIDIA over the past year or so. And it also, that valuation solidifies OpenAI's position as the third most valuable venture-backed startup. So the top five, based on the latest rounding of funding, you have Shein at number 5, at $66 billion. Stripe, which is a payment software company, at $70 billion. OpenAI in third place, $157 billion. Elon Musk's SpaceX at second place, $200 billion. And then in number 1, ByteDance, which is the parent of TikTok, $225 billion. So it's up there.
Some big names on that list.
Yeah, exactly. Yep, exactly right. So
crazy. It's done extremely well in such a I shouldn't say such a short amount of time, because obviously the development of ChatGPT went long before it was released. But since release, it's just caught on like wildfire. It's been something quite remarkable.
Yeah, I know it's cliche, but in the next few years, it's going to be, I think, quite astounding where it'll be. At least if the current rate of change continues to happen, maybe it'll plateau. But it's certainly an exciting time to be if you're into tech or anything like that. It's really fascinating to watch. That's it. So, do you want to take us through? Another company raising capital? What's going on with Boeing?
Yes, Boeing is also raising capital, as you say. They're going to sell some shares, but they're probably not quite on that same trajectory as OpenAI. So it says here, Boeing is considering raising at least $10 billion by selling new stock, as the plane maker seeks to replenish cash reserves depleted further by an ongoing strike according to people familiar with the discussions. The company is working with advisors to explore its options, said the people, asking not to be identified, discussing confidential matters. Raising equity isn't likely to happen for at least a month, assuming the plane maker can resolve the strike, because Boeing wants a firm grasp of the financial toll from the walkout by 33,000 workers, the people said. Ouch. A spokesperson for Boeing declined to comment. No final decision on timing has been made or amount. And Boeing could end up deciding against the move. The people said, oh, well, they could do it. They might not. No, it sounds like they're going to do it. Boeing is under pressure to shore up its finances and hold onto its investment-grade credit rating. That's the important part of this story. The company is one step away from dropping into speculative territory, which would further drive up the cost to service its $58 billion debt load. So that's what they're trying to avoid right now, is they're trying to avoid having to pay more interest, I guess. The situation has been exacerbated by the strike, now in its third week, that has shut down output of Boeing's single-aisle airliner, as each day of stoppage further dents reserves. The US plane maker has seen its financial reserves dwindle in the wake of a near-catastrophic accident in January that forced Boeing to slow down its production of the cash cow 737 MAX airliner. Should Boeing proceed, a sale of that magnitude would stand to be the biggest by a public company since Saudi Arabian Oil Co's $12.3 billion sale in June. And, you know, it's a tough spot for Boeing to be in. The problem that I have really about this is that this is really going to hurt shareholders, because I had a look before. Boeing stock is still down 65% from its pre-pandemic highs.
Yep.
So a massive sale of new shares is unfortunately going to dilute shareholders. They can maybe you can make the argument that that's the lesser of two evils if it comes to that, or your bonds being rated as junk or speculative, and you have to pay higher interest on a high debt load. I don't really know. I haven't crunched the numbers, but I don't know. As a shareholder, it's a tough cop. It's a rough cop. I don't know if I like it.
And to make it even worse, prior to all of these problems, the company has been an aggressive share repurchaser. And so at much higher stock prices, they were spending money. In a lot of cases, they were just borrowing money and then using that money to repurchase stock. So they've copped now interest payments that are a lot higher than they were when they borrowed the money as well. And they've repurchased a bunch of stock at a much higher price, and now they might have to sell those shares back at a lower price, which all is very bad. In 2014, they bought back $6 billion of stock. Then it was $7 billion the next year, then $7 billion, then $9 billion, and then almost $10 billion in 2018 before the problems started to happen, and they basically cut their share repurchases. But that's essentially the opposite of what you want to see. You know, you would have loved for Boeing to be flush with cash. These problems hit and they're unfortunate, but because they're flush with cash, they can repurchase stock, and they can, at least increase the ownership for investors during this kind of temporary down period, if it is actually temporary. Of course, that's an assumption in of itself. But very, that's the risk of these kind of companies that assume that they're stable. They often get very comfortable taking on lots and lots and lots of debt and distributing it to shareholders with the assumption that, everything's just going to be fine. And if it's not, then you can get in these tricky situations where investors, you're right, like the stock is down a lot. So investors have lost a lot of money in that respect. And now the value of each of their shares, the percentage ownership, could actually also go down from being diluted. So, it's not a good place to be.
Yeah, it is a rough place to be. I'll talk to you about some of the financial data. Boeing faces a liquidity squeeze after burning through $8.25 billion in free cash during the first half.
Wow.
The US plane maker slowed work on its cash cow 737 MAX and other jets to address quality lapses brought to light by the accident on January 5th. Workers have rebuffed 2 offers from the company for higher pay, and the two sides have engaged a mediator to help overcome the impasse. Analysts expect Boeing to suffer a $3.36 billion cash outflow in the third quarter, according to data compiled by Bloomberg. The strike stands to cost the company about $1.5 billion for each month that workers stay off the job, according to estimates by JP Morgan. The outflows risk lowering Boeing's cash balance to the point where the three major ratings agencies would be compelled to act. Fitch Ratings has warned that an extended strike could have a, quote, meaningful operational and financial impact, increasing the risk of a downgrade. So you got this, it's a tough spot because they're being beaten down, they've got quality control issues, and then, to make matters worse, all their workers go on strike. But that's the thing, is that this is burning through their cash and they need to do something about it.
Yep.
But the thing is, if they weren't under such a cash crunch, this wouldn't be all that much of an issue because at the same time, Boeing has an order backlog of 5,490 aircraft, representing about $500 billion worth of revenue. The 737 MAX is largely sold out until the end of the decade, and European arch-rival Airbus is also struggling to ramp up production, has been unable to meaningfully capitalize on Boeing's woes.
Right.
So it's like the business is there. And this is where I guess Boeing does have it's kind of an oligopoly. They kind of have that protective moat, but they just can't quite access that moat at the moment, and that's putting them under a lot of pressure.
Yeah, and it's because they're in a bad that's just poor financial management. Like, they've chosen over the last decade to distribute excessive amounts of money to shareholders. This would never happen to Berkshire Hathaway. This would never happen because their credit rating is never in any doubt because they have enormous amounts of cash, and they would never, they do share repurchases. They do, distribute in that way to investors sometimes. But they've always got money. They're always protected. Companies that have these big moats, they often get very comfortable. Starbucks is in a similar position. They've done excessive distributions to investors and they've loaded up on debt, and maybe they'll be fine, but if they face a big problem, they're in a similar boat where you start to get whacked from every direction. You need to raise capital, but then you're burning cash, so your credit rating is at risk, and if the credit rating goes down, your interest rate goes up, and it gets even more difficult. And so I think it is it does speak to the importance of it's not just a moat, it's also how's the company protecting itself, in the event of something terrible happening, where they just need to draw on a bunch of cash.
No, you're exactly right, Hamish. It's a tricky spot to be in, but could have been avoided. And now they must suffer. Suffer, Boeing.
Yeah.
And at the same time, they've left however many astronauts stranded up on the ISS.
Oh, yeah, that's right.
Yeah, they got to go get rescued by SpaceX. That's a whole other story. All right, Hamish, bring us home. Costco, what on earth are they doing?
Yeah, this is just a short, a fun story just to finish things off. But Costco has been expanding its commodity product line, announcing on Wednesday that it will now sell 1 ounce platinum bars for $1,089.99 on its website, alongside the gold bars and silver coins that it had previously and started selling last year. So platinum, you can now buy.
That's so weird.
Yeah. You can now buy platinum from Costco. So. So the gold bars launched at Costco in August of last year, 2023. And not even within 2 months, they were already selling out within hours of a restock. So every time they would restock, they'd be selling out within hours.
Wow.
The then chief financial officer of Costco, on the company's earnings call in September 2023, said, when we load them on the site, they're typically gone within a few hours, and we limit them to 2 per member. So even with heavy limits on, you can only buy 2 ounces of gold per person, and you of course need a Costco membership to even access any of this, which is like $100 a year or whatever it is. Even in that case, they're able to sell a lot. And it is actually a lot. It's not as if they're just putting a little bit up and it sells out. Analysts at Wells Fargo reported that in April, Costco was selling as much as $200 million worth of gold every month. And so,
Wow.
so they're selling billions of dollars in gold.
That is crazy.
Yeah, that kind of shocked me.
I wonder why. What can... I don't really understand why they're doing it. Why are they selling gold?
Yeah.
But it's working. I just don't quite understand the strategy here.
Well,
is it just like trying to make it easier or a more understood, well-known place for people to go and shop, and now they can also shop for gold, and it's making it easier for people if they want to buy a gold bar or something? Like, I don't know.
That's what I was trying to figure out. I was trying to figure out why they're doing this. The kind of the official kind of reason they're doing it is they do make a profit on it. It's not very much. It's estimated they sell the gold bars, for example, about 2% above the gold spot price. So they're making a very small margin on the gold bars. So they are making some profit from them. But beyond that, it's 2% is not very good. And, it is 200 million a month, which is a big number, but 2% of 200 million a month isn't. So they're not really making that much money from it compared to their, say, 15% margin that they make on their other goods. And so I was trying to figure out why, beyond just having more variety for their customers, which is something that Costco kind of prides themselves in. I don't really know. But yeah, it is just a kind of another commodity, I guess, that or another thing that people can buy at Costco. So that was, gold and silver started last year, and now it's platinum. So you can buy an ounce of platinum if you want.
There you go.
If you're in the US,
I don't even know what platinum's used for. Besides potentially a store of value, maybe jewelry. Platinum jewelry, I think, is a thing.
Okay, yeah, I don't know.
Gold, silver, and platinum.
I'm not really.
Yeah, I don't know.
I'm not really sure. What does it say here? The value of gold has risen more than 40% in the past year and over 70% over the last 5 years. So gold has been very good this year, given some of the economic uncertainty that tends to be the case. But the price of platinum has been a little bit more rocky. The value of platinum has risen more than 15% over the past 12 months, but it has dropped more than 8% since peaking earlier in 2024. So it's a little bit more up and down, I think. But yeah.
Interesting. Well, there you go.
Yep.
If you want some platinum or some gold, you know what to do, everyone.
And if you live in the
Open
US.
up your Costco accounts. Yeah, and you live in the US. Yeah, true. Oh, very interesting. We'll see how it goes for him. 2% margin. I don't know. I don't know if I like that. But, yeah. Good luck to him. All right. Well, let's wrap this up, Hamish. I got to get out of here. Yep. Much appreciated. Thanks for joining me as always. That was a good little episode. Some quite interesting stuff to talk about.
Yeah.
Thanks always for tuning in, guys. We do appreciate it. Please, if you would like to, leave us a good review on whatever podcast platform you listen on. That stuff really does help out. If you made it to this point in the podcast, we would really appreciate a nice review. And apart from that, leave a like if you're watching on YouTube, subscribe, follow the podcast depending on what platform you're on as well, so it gets served to you every week and you don't have to think twice about it. But apart from that, we're going to jump out of here. Thanks very much for listening. Thanks for watching. And we'll see you guys next week.
See you guys.